Fed operations and what the Fed can do operate with a lag. So how do we need to interpret the data given the lag in Fed policy?
Well, I mean, at this point, absolutely every number print will mean something to somebody.
Jobs on Friday, for example.
Jobs on Friday, GDP data, you know, everything from are people paying their rents, what will happen to mortgages, absolutely everything will have an impact. And because we don't have forward guidance, that volatility will be there every single time we get one of those prints.
Okay, Dana, thank you very much. Bloomberg's Dana Beltagi joining us there with the latest on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart Sergei Lavrov about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg's learned that the U.S. would swap them for a Russian arms dealer it holds. According to Russian media, though, Moscow says there is no agreement yet. SEC Chair Gary Gensler warns that the U.S. and China must reach a deal soon to prevent Chinese companies from being kicked off American exchanges. The dispute has to do with whether American auditors can have access to the work papers of about 200 Chinese companies. If not, those companies could be forced off U.S. exchanges as soon as 2024. On Capitol Hill, the House is expected to approve a bill that includes $52 billion for U.S. semiconductor manufacturers. The Senate passed the measure Wednesday. It's a major legislative victory for President Biden. The U.S. chip industry has steadily lost ground to overseas rivals in recent years. And Ford CEO Jim Farley says the automaker has too many employees, but he's not saying how many he plans to get rid of. On an earnings call, Farley made it clear that job cuts are coming. Earlier, Bloomberg had reported that Ford is planning to slash as many as 8,000 salaried jobs. Farley wants to cut $3 billion in costs to help finance the shift to electric vehicles. And Creedy, this is something we're seeing across industries, not necessarily outright layoffs, but hiring freezes across many of the big tech companies. And I expect we're going to be hearing more of that in the coming months.
You know, and it's interesting. There's a big difference between hiring freezes and widespread layoffs. And when we're talking about whether or not we are in a recession, a technical recession or a real one, as Mike McKee would point out, the economists say, one of the recessionary dashboards is, do we actually see those layoffs? So it's almost like we're on the cusp of that meeting that criteria, but we're not quite there yet.
Yeah, absolutely. When the labour market is the only thing that stands really in your way, there's a lot of focus on the labour market. We will continue to focus then, Kaylee, on the auto sector a little bit later on. You were mentioning Ford. We'll talk to Stellantis.
Yep, Carlos Tavares is coming up, and we'll also talk the U.S. economy and that labor market. Ryan Wang, the U.S. economist at HSBC, will be joining us for that conversation and reacting to the Fed's 75 basis point hike of yesterday. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell signals that more interest rate hikes are on the way, but he's not giving any specific guidance and says the pace of tightening will slow at some point. From big tech to big oil, investors have a lot of earnings reports to consider. Meta disappoints, Shell sets another record, and we'll hear from Apple and Amazon today. And a surprise deal on Capitol Hill. Leading Senate Democrats agree on a tax, energy and climate plan that enacts major parts of President Biden's agenda. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lyons in New York. Matt Miller is off today. And Kriti, that post-Fed dovish interpretation of what we heard from Chair Jerome Powell seems to be fading a little bit. Futures pointing lower.
They're pointing lower, and I would say the selling is actually accelerating even just in the last 30 minutes since we did our last market check. If you actually look at futures now, I believe they're down about 0.5%. So there isn't a ton of movement in terms of the upside conviction. But remember, this is kind of normal when you see a NASDAQ that outperformed so much yesterday. I think over 4%, the S&P 500 closing over 2%. It's only natural to pull back some of those gains. And I think that's what you're seeing in futures. And there's really no kind of overriding risk-on sentiment that you're seeing, even in the bond market, really unchanged here, 278 on the 10-year. Even if you're looking at the crude market, once again, in a volatility-induced context, a 1.8% gain on NYMEX crude isn't really screaming buy risk at the moment. Bitcoin even up 0.3%, that massive macro risk indicator, Kaylee. Once again, it's not screaming risk on. It's higher, but not risk on.
All right, Kriti. Well, of course, in addition to the big macro picture and the Federal Reserve decision, we also continue to have earnings rolling out from big technology companies. We had a number of them after the bell yesterday, including Meta Platforms, which is the operator of Facebook. It reported its first revenue decline on record in terms of revenue growth, and the forecast also disappointed. The company talking about the slowdown we're seeing in ad spending as that economic environment starts to slow, but they're also struggling with competition from TikTok as well as those Apple privacy rule changes. So that stock is down the better part of 6% before the bell. Qualcomm also lowered. The big chip maker for smartphones is warning of demand deterioration because of those same weakening economic forces. So its forecast disappointed. It's down 4.5%. And then another retailer giving a profit warning. Perhaps we shouldn't be surprised after what we've heard from Target and then Walmart earlier this week, but Best Buy cutting its profit outlook, saying that consumer demand for electronics is fading with inflationary pressure. So that stock is down more than 4%. And I wonder, Anna, what the read-through of that will be when Amazon reports after the bell today. Revenue growth is expected to slow to just 6%. How much are they seeing that consumer weakness as well? Ahead of those results, the stock down about 1% before the bell.
Yeah, interesting to see that part of the business and the role it plays in revenues, whereas cloud, the role it plays in profits, of course. Let's check out what's happening on European equity markets then, Kaylee. We have European stocks pretty flat now. The point that I was making with Kriti earlier, we've seen a bit of a fade in that positive post-Fed market mentality that we've seen, that dovish interpretation. Seems to be fading just a little bit. There's a really complex picture when it comes to earnings coming through here in Europe, and the geographical picture diverges quite a bit as well. So different European markets heading in different directions today. Net, we are flat. Barclays down by 2.3%. The numbers seem to beat on a number of areas of the business, but it's concern around costs, litigation and conduct costs in particular, climbing at that company. Shell up by 1.75%. The second quarter in a row of record profits coming through from this big oil and gas and energy major, and a big buyback as well. And Vestas, we put this in as well because of the perhaps unexpected meeting of the minds between President Biden and Joe Manchin. And so as a result of that, progress on that energy agenda is being priced into markets, and we see wind businesses and solar businesses really surging today, Kaylee.
All right, Anna, well, let's get back to the Federal Reserve because Chairman Jerome Powell rejected speculation yesterday that the U.S. economy is in recession, but Scott Minerd of Guggenheim disagrees.
It is really hard to argue that we're not in a recession. Given the fact that, for instance, just one indicator, the leading economic indicators have had 4 down prints in a row on a monthly basis. Every time that's ever happened, that is essentially a signal that we are in or we are about to enter a recession.
And investors may get some clarity when the U.S. reports the initial reading of second quarter GDP today at 8:30 a.m. Wall Street time. Ryan Wang, U.S. economist at HSBC, is joining us now for more. So, Ryan, obviously, we didn't get firm forward guidance from Chairman Powell yesterday. They are going to be watching the data like today's GDP print. But just more broadly, as you listen to the chairman, the market perceived it as dovish, everything that he was saying. Was it?
Well, that's right. On the one hand, Chair Powell started his press conference exactly the same way as he did in June, which is to emphasize that the FOMC is committed to controlling inflation. But as the press conference went on, it became increasingly clear that the policymakers are also attentive to the downside growth risks. And it is a complicated economic picture. Last year, we had a very strong year for economic growth, so it's understandable that things are cooling off. I think what the FOMC is most concerned with is making sure that that slowdown doesn't become even more severe than they might anticipate.
So you think he's attentive to the growth risks, and so perhaps that underscores why we saw that dovish interpretation, Ryan. But at the same time, there is a sense also that the market is, Jerome Powell kept referencing the Fed's own estimates, their own guidance around where the terminal rate's going to be, and suggesting that people should look back at the June forecasts. And with that kind of messaging, you could conclude that the market needs to price in more hikes, not fewer.
Well, that's true. Right now, we're in a transition period. What we've seen is a slowing in economic growth, and it seems to be fairly broad-based across a few different sectors. And Chair Powell mentioned a few of these. He talked about weakness in the housing market. He talked about slower growth in consumer spending and the potential that business fixed investment is already declining. But that hasn't translated into a slowdown in the inflation numbers. Now, logically speaking, if we do see economic slowing and if we see some weakness in the labor market, and Chair Powell talked about this as well, that that's part of their forecast. After all, that's the intention of tighter monetary policy. Well, it's reasonable to think that that might eventually lead to a cooling off in these price pressures. But we haven't seen that in the data yet. So you can understand why you have to maintain a flexible approach as a policymaker, because once again, the biggest risk is that inflation expectations become unanchored for a long period of time. And in some ways, that could be even worse than the economic slowdown that we're seeing now. Powell went back
Ryan,
to
I was going to ask, which is the data point then that you're going to be laser focused on? Of course, we know the Fed is laser focused on inflation then, but what is the data? They're data dependent now. We're a little bereft without the guidance we used to get. So which is the data point that really is going to matter to you most?
Well, of course, it's the inflation numbers that you mentioned, but then it's also the whole full spectrum of labor market data. And what's interesting is that even if you only focus on the labor market data right now, they already show a bit of a contradiction. In the US, we have this unusual situation where we have two separate measures of employment. One calculated by asking businesses how many employees are on the payroll, and another by asking households whether or not they're employed. And right now, over the last 3 months, those two measures are showing a bit of a divergence. The so-called household survey has been much closer to unchanged or flat, not really showing any jobs growth over the last 3 months. Chair Powell actually mentioned this in the press conference, so you can tell that the policymakers are laser focused on these divergences in the economic data.
Ryan, the market is also pricing in several rate cuts going into next year. I'm curious, what do you think it's going to take for the Federal Reserve to hit the brakes?
Well, I think the number one focus is still going to be making sure that inflation is moving lower. I don't necessarily think that inflation has to come all the way down to the Fed's 2% target for the Fed to stop raising rates, but we need to see progress in that direction. And so this is why this whole configuration of economic data is so important. We need to look at what's happening with wage growth. Again, we see a divergence in the economic data. The average hourly earnings series have shown a little bit of signs of slowing, but other measures, including the very important employment cost index, has still been running at a high level. So the next reading on that indicator will also be important. Chair Powell mentioned that as well. So if we see that businesses are becoming less confident about the economic outlook, they're slowing down their hiring needs, and that's translating into a deceleration in wage gains across the economy, then the Fed might eventually think about slowing down and eventually stopping its monetary tightening cycle.
But there's other pieces to the equation, too. You have financial conditions that are in restrictive territory. You also have QT in the background. Are you concerned at all about the liquidity picture?
Well, the quantitative tightening process it's really just getting underway, and this came up yesterday as well. Chair Powell talked about this potentially being a 2 to 2.5 year process, although no decisions on that front have been made. So it's another case of not just watching the economic data, but also watching financial conditions across a broad range of markets. And of course, we know that the financial markets impact the economy through financing channels. So this combination where businesses are becoming a bit more uncertain about what future demand will look like, and then you have financing challenges potentially through what's going on in markets and broader debt and equity financing. This again adds to the challenge in interpreting what's going to happen over the next 12 to 18 months.
Brian, thanks so much for your time. We appreciate it. HSBC's Ryan Wang with us to talk about the US economy. Coming up on the program, an exclusive interview with the chief executive of the automaker Stellantis. We'll talk chip shortages. We'll also talk about the possibility of an energy crunch here in Europe. What does that mean for the business? This is Bloomberg.
The energy markets are tight and will remain tight and volatile, I think, not only for the remainder of this year, but also well into next year. Where will it go from here? Let's see. But I'm quite optimistic, both on the energy system as well as the global economy.
That was the Shell CEO, Ben van Beurden, speaking earlier on Bloomberg. Shell reported record profit for the second quarter in a row due to high oil and gas prices. He's quite optimistic, he says. Let's check in with another sector. In other earnings news, Stellantis sees its strong earnings continuing into the second half of the year. Stellantis and its peers have bolstered margins by raising prices and selling more high-end models in response to production curbs sparked by chip shortages. I'm pleased to say joining us now is Carlos Tavares, the Stellantis CEO. Carlos, it's a real pleasure to speak to you. Thanks for joining us. You've said today that the chip shortage will continue for the rest of the year. I wonder, have you got any sense of when you will have all the chips you need to make all of the cars that you want to?
Well, thank you, first of all, for inviting me. It's my pleasure to have this discussion with you. On the chip front, what we see is that the situation is improving, but improving very slowly. We see that the production planning is smoother, that there are less last-minute changes in the production planning. And most importantly, what we see is that the number of troublemakers is much more reduced than it was 1 year ago. 1 year ago, we would have 10 troublemakers in terms of supply. Right now, we only have 2. So our forecast is that the situation will continue to improve through 2022, steady but slowly. And eventually it will be fixed by the end of 2023. So it's going to be still a long process. Okay. And we'll have to adapt to that. Most probably will be supported by the fact that the consumer electronics market is going down, and that will shift some more production to the automotive side.
Okay, that's an interesting perspective then, Carlos. So give us a little more granular detail on where these troublemakers, where they come from. What is it exactly that drives the delays?
Well, it's very interesting to understand. It's at tier one level, tier one supplier level, and we see a big competitive gap between those who are now able to control their own supply chain and create the appropriate buffers that protect their customers like us, and those who are still unable to do so. So it's now a very competitive landscape at tier one supplier level, where you see big gaps in terms of expertise to control the supply chain. That is going to become very competitive for the tier one suppliers, of course. It's going to be also very important for OEMs like us to select the right partners for the future. And as you know well, we are progressing very fast with a 50% sales increase rate on our BEV sales, and we are taking more and more depth in controlling our supply chain, including on raw materials.
Well, Carlos, clearly for some time now, the problem has been on the supply side. I'm wondering if there will soon be a problem on the demand side, because as Anna mentioned, what you're benefiting from is higher prices, focusing on higher end models. As the economy deteriorates and consumers perhaps become more price sensitive, how confident are you in your ability to continue focusing on that?
This is a great macroeconomic question, and I will try to answer in the following way. Yes, the transaction prices have increased significantly as the consequence of the imbalance between the offer and the demand, which is the consequence of the semiconductor supply crisis. On the other hand, we have been suffering from a significant cost inflation coming mostly from energy as a consequence of the Ukraine war in Europe, and a consequence also on raw materials cost inflation, mostly on steel. What we see now is that as some actors are anticipating on the slowdown of the global economy, if not a recession, we see that the price of steel is now going down, which is a good thing to accommodate eventual lower prices moving forward if the semiconductor supply was to normalize. So we see that may happen on one side. On the other side, we also expect that some of the raw materials will cool down, and that we will bring the business to the, I would say, the usual point of management that we had on pre-COVID time. So I think the two are going to a certain extent to compensate each other.
Okay, so perhaps become more into balance. You mentioned higher energy prices, and I'm wondering how Stellantis is planning on managing through the energy crunch in Europe and the inevitable secondary effects of that, including a broader economic slowdown.
Indeed, this is a point of attention. Actually, we have by far the largest manufacturing footprint in the European region, by far. And we are very, very limited in Germany, which is going to be the first country to suffer from this energy crisis. We have only 3% of our production made in Germany, as we have plants everywhere in large Europe. So we are very, very much robust against that kind of situation, even though we are now preparing a short-term contingency plan to protect our German plants from that gas supply crisis. But we don't expect that to be a big problem for our company, as we have a very large manufacturing footprint all over Europe, including the southern part of Europe, which is much less affected by the energy supply crunch.
Well, let's go from Europe to China. You had a joint venture in China and have pulled out as to stop producing Jeeps there. I'm curious why.
Very simply because we had a binding MOU with a partner that did not do what he was expected to do against that binding MOU, and as a consequence of that, we considered that it was better to unwind that operation, which, by the way, was a loss-making operation, and therefore we are going to fix this issue. We have been seeing over the last few years more and more political interference in the world of business in China, and of course, this example is a perfect translation of that situation. So we just took the consequence of having a partner that was not willing to execute what was agreed previously in the written and binding document for that JV to change its shareholding footprint. So a very natural consequence in business. And we are now focused on the highly profitable CBU business that we have in China. We'll continue to address those highly profitable niches of the market. And of course, we are implementing an asset-light strategy because we are also anticipating on geopolitical tensions that could end up with cross-sanctions between China and the rest of the world. And we don't want to be a victim of those cross-sanctions, as it has been the case for other companies in other regions of the world recently.
Okay, thank you so much, Carlos. A very interesting conversation, covered a lot of ground. Thanks so much for joining us. Carlos Tavares, the Stellantis CEO, joining us there from Paris. Coming up later today, Ford Motors CFO, John Lawler. So sticking with the autos theme, that conversation at 10:45, New York time, 3:45 in London. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Very much what the market was looking for, and that's why the market reaction has been muted. I don't think the pivot will occur as soon as some people are hoping for, and if it occurs, there's going to be a lot of questions about, is this the stop-go Fed of the 1970s?
That was Mohamed El-Erian, the Bloomberg opinion columnist and Queen's College of Cambridge president on the Federal Reserve. Now we bring in Tom Keene, who led our Fed coverage yesterday. He joins us now with a single best chart. Tom.
You talked about stop-go. Dr. El-Erian harkening back to the 1970s. Let's do that. And the memory of the 1970s is Chairman Powell's biggest headache, and that is housing. Housing is a huge part of the American economy. I'm advantaged in that Justin Fox of Bloomberg Opinion has a spectacular must-read housing summary out in the recent weeks. I put it out on Twitter for your review. This is Mr. Powell's chart. This is the headache. This is rental vacancies nationwide, and we truly are back to the 70s, and that's not a good thing. Down we go from 11%, cutting in half vacancies over the last good number of decade, I'll say. And the fear critic is if we break below that to like a 4% vacancy rate nationwide, that is frightening what that will do to rents and what it will do to the measurement of price change.
Well, in talking of the U.S. economy, I noticed a tweet from Senator Bill Cassidy yesterday saying Biden's inflationary American Rescue Plan has become the American Recession Plan, and you're going to speak with him today.
Yeah, we're going to talk to the senator. I'm not sure where we're going to take that. I think we've got to go to the current news, which is the legislation in Washington. But the linkage here of inflation into recession obscures the fact that you can have many flavors of recession. We'll lead with that with Frances Donald here across the show. She's always good on the makeup of GDP, but I really take issue with the recession gloom that's out there. You never know if you're going to have a recession. You never know what flavor it's going to be. It's like Howard Johnson's from years ago, except Kaylee, you don't know what Howard
I know
Johnson's.
life is like a box of chocolates. You never know what you're going to get.
Orange
Forrest
roof.
Gump reference. All right, Tom Keene,
Orange
thank
roof.
you so much. Now, as for what else we're watching today, tech earnings for me. Amazon and Apple due after the bell. 10% of the market cap of the S&P 500. Watching for clues on consumer demand and China and inflationary pressures, Creedy.
And at the same time, well, I should say a few hours ahead, we also have that GDP data. Technical recession perhaps on the cards. What does that mean for the bull case for stocks, Anna?
Yeah, absolutely. So a lot to go on the U.S. data front. I'll be watching the Spanish government as it introduces draft plans for a windfall tax on banks and energy companies. This has been floated back on July 12th, but we don't have any details. So we'll watch response. And that market underperforming the rest of Europe. The rest of Europe really pretty flat, actually, today. A mixed picture across European stocks as U.S. futures point lower. NASDAQ futures, though, pulling back from earlier losses, now down by 0.7%. That is it for Early Edition. Surveillance is next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
if you're a Fed who cares about inflation or cares about unemployment, the right thing to do is to address inflation head on.
For now, they're very much still steering towards higher interest rates and higher inflation. So I don't think they're going to pause.
The economy's been stronger than I think that people realize.
We do think that the market is over expecting a Fed pivot in the near term. I can't see how that happens.
I don't think the pivot will occur as soon as some people are hoping for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is GDP Day, live from New York City. For our audience worldwide, I knew you'd like that. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Bramo said I need to straighten my tie, Tom. Seconds before we came live.
Yeah, you didn't say that. You were asking, and I said, maybe right over here.
Okay.
You look great.
Thank you. Let's
So
get
do
it
you,
together.
Tom.
Futures down 1/3 of 1%. Why are you buttering us up? On the Nasdaq 100, we're down about 3/4 of 1%. TK GDP coming out a little bit later.
GDP coming out, to me, it's really, really important. It's always underplayed by the media, John. We look at one statistic. You know what? It's hundreds of data points as a first look, second look, third look. John, you put out on Twitter the huge dispersion on Wall Street. Really remarkable.
I have to say, the recent forecast, the updated ones, they lean a little bit more optimistic, constructive after the data.
Well, yes, after inventories as well. John, I got to cover the surveillance pivot right now. The surveillance pivot is very important. It's far more important than the Fed pivot. The surveillance pivot is we promise folks to try to get 6 hours sleep here as we
a little bit later. Is that the big pivot? What do you make of the What do you make of the Fed pivot? Can we even call it that? Some people are saying we saw the first signs of it.
This is really important. Ending with Michael McKee's non-answer to Michael McKee's good question. Colby Smith of the FT asked sort of a convoluted question. She got it out. I don't know what was wrong with her, but she moved the market with his answer, John, and that was where we were off to the races. And what was it about? It's about forward guidance. It's gone. And I'm sorry, John, even for the sophisticates, that's a new idea.
Sure. So you leave space for a forward guidance-free, data-dependent stance. And what did the market do? Rushed in, Lisa, with some kind of dovish interpretation of what was going on.
So I was searching for some sort of explanation other than the market is just wrong, because that was my knee-jerk reaction, and basically saying, I don't really see where they're getting their enthusiasm just from a lack of knowledge. Some of the analyst notes were pointing to this belief that Fed Chair Jay Powell has, a controversial belief that we're getting closer to neutral. That was something Bill Dudley pushed back against. Also, this belief that there is a risk of going too far, in addition to not going far enough. A recognition of the pain that a vulgarized Fed could possibly cause. So these are some of the reasons people are giving. I don't know if I buy it, though, because how could you get a knee-jerk rally that was the biggest in the NASDAQ going back to November of 2020 on the heels of this?
Here's a tough one. If Chairman Powell had what we had in front of him in that news conference, which is a list of stock market indices in front of us here, how do you think he'd respond to that? Do you think that's the outcome he wanted to see?
So Bill Dudley was saying that basically if the market rallies 5 to 10%, and I assume he was talking about the S&P, not the NASDAQ, that would actually go against what the Fed is trying to do. Some people could say this goes against what he's hoping for. Others would push back and say there's already been so much bad news priced in, and the rally is actually a sign of optimism that perhaps we priced a lot of this in.
John is looking at the AC Milan's futures here and what the friendlies are going to be for AC Milan. I'm actually doing technical analysis while Mr. Powell was going on. And John, unequivocally looking at what's called a point and figure chart of the Standard & Poor's 500, we really haven't had a bear market breakout. It was a big pop yesterday. And today, with the tech earnings, is a big now what Thursday.
I'm just so pleased one of us is doing the work, Tom.
It's good.
And that person is you. Futures on the S&P, negative 1/3 of 1% on the S&P this morning. We declined on the Nasdaq 100, down 0.7 of 1%. To TK's point, a little bit later, we're going to have some big earnings from Apple, from Amazon. Bramo's going to go through the data points, the earnings you need to watch for the day ahead. Yields unchanged, Lisa, 277.94 on a 10-year this morning.
Okay, so here's what we're looking at. It might be GDP Thursday because we are getting that initial read on the second quarter GDP for the United States. People wondering whether this is a technical recession. That has been allayed given some of the data that we saw yesterday. That comes out at 8:30. I actually am more interested in initial jobless claims. The GDP print is backward looking. The jobless claims is a more real-time version of the labor market that seems to be the data point that Fed Chair Jay Powell was pointing to yesterday. Yes, weakening data. However, jobs remain very strong and in full supply. At what point Does that dual mandate, John, as you put it yesterday, become more in a conflict in terms of fighting inflation and supporting the labor market? Today, a slew of policy discussions, including a really important call between President Joe Biden and Xi Jinping of China. We don't know exactly when that will be, but reportedly they will be speaking about a number of issues, including tariffs. Will the U.S. remove some of the tariffs from the Trump era on Chinese goods? And of course, Janet Yellen will also be speaking at 1:30 p.m. on the economy. How does she spin some of the data that we got earlier today, as well as the Fed's reaction to it? And after the bell, just to give you some perspective, about half of companies in the S&P have reported second quarter earnings so far. After the bell, Intel, Apple, and Amazon are among a slew of companies reporting earnings that account for nearly 20% of the S&P. How much do we get a sense, particularly with Apple, of what the consumer demand is like for electronic goods? Because, John, we have seen an increasing amount of softening. There has been resilience in the likes of Google, resilience in the likes of Microsoft. Do we see that continue for Apple?
Those two names, Apple and Amazon, about 20% of the NASDAQ 100. Just those two names.
Yeah.
Lisa, Tom Keene, some big earnings coming up a little bit later.
They are, and it is about China. And I agree with the different punditry I'm seeing across the Bloomberg terminal that Apple's a huge mystery. And as Julian Emanuel and his team say at Evercore ISI, they're really going to focus on the conference calls of Apple and the guidance forward, because it's, as Alarian would say, it's an unknown right now.
Let's get some guidance forward. We can do that with Eric Friedman, the Chief Investment Officer at US Bank Asset Management. Eric, you have been more conservative, somewhat bearish on global equities. Did that change yesterday?
It didn't, Jonathan. I think that getting back to the technical comment, for us, our proverbial bear costume would get a little bit itchy at around 4,200 in the S&P. I do think that there was a pivot. It was that meeting-to-meeting guidance forward viewpoint from Chair Powell. And so what I think that means for us as professional investors and our peers is just how strong is your conviction about higher prices remaining sticky? And I think the second thing is how convinced are we that the liquidity picture dries up? And so those are the two variables that we still think are concerning, still leave us with more of a bearish tilt. But again, that meeting-to-meeting guidance requires our models to be that much sharper, given where we are from forward guidance versus meeting-to-meeting guidance.
Eric Friedman, is your team noting that corporations are adapting? I mean, it's the oddest time that we're in right now. We certainly noticed that with Chairman Powell. Are corporations adapting and adjusting to this new post-COVID landscape?
Tom, I think that's a really important observation. And I think that we in the financial community steal a lot of things from other industries. And that concept of homeostasis, or basically the adjustments that companies and consumers and governments make in a system like an economy, is very much intact right now. And I think that the center stage for that, and it really ties into your earlier comments about GDP, are what's happening in inventories. You've heard that from both big box retailers as well as e-tailers, that it's been a difficult exchange between information from consumers and obviously suppliers about what they should be stocking their shelves with. So we think that this adjustment process from stocking goods, as well as the experiential travel variables we're of course paying attention to right now, that we think is going to take a couple quarters to sort out. The consumer is a moving target. And again, it speaks to that notion of that homeostasis, that readjustment that's happening in real time.
So, Eric, you still think that there is some pessimism that hasn't been baked in, certainly to risk assets. But what do you then do with your investments? Because bonds have also rallied at a time when the Fed is basically saying we're going to do what it takes to get inflation down. At a certain point, do you just hide in cash and wait for that clarity?
Yeah, Lisa, we've been really of the mindset that there's not going to be that proverbial Minsky moment where we just see credit spreads blow out and equities fall asunder. But we do think that there is going to be probably a drip lower in earnings especially. And so I think that while this earnings season is important, next earnings season is more important. So our viewpoint has been, let's add a little more to infrastructure, add a little bit more to real assets, not necessarily taking a bet on oil and hydrocarbon beta, but really paying more attention to the reopening trade that's happening very gradually. So that's been one thing that we've been emphasizing in portfolios. From a duration perspective, we've really been leaning more towards shorter duration, just with the viewpoint that we have to see, again, how this forward guidance shakes out. We're actually getting a little more interested in buying duration here. But again, our viewpoint is that the rotation back into, let's call it, lower quality equities, Europe is really something that we're to wait for another quarter. So really more taking benchmark relative risk in terms of shorter duration, as well as a little less equity exposure, more infrastructure is the way we're thinking about things right now.
A wait and see stance. Eric, thank you. Eric Friedman there of US Bank Asset Management. Lisa, this is what the big bulls, Marko Kolanovic at JP Morgan, have been waiting for. They think this is evidence potentially of peak Fed hawkishness. It's behind us and you can buy this market again.
When was the last time that we said that?
I think the last meeting.
Exactly.
The day
at
off.
what point? Peak hawkishness for them saying we're now going meeting to meeting. Is that basically a bet that CPI, that headline consumer inflation, is going to come down pretty dramatically, and that the Fed is going to face a dramatically weakening economic outlook at a time when a number of the statistics have been beating, when companies are still actually doing better than many expected? How do they parse through this and get to a place where a Fed is going to fight inflation, get it down to 2%, and still manage not to raise rates much further than where they are right now?
It's both, if that helps. Clearly, the bet is on the data.
Right.
And we're going to be so sensitive to the incoming data, Tom, over the next few months, going into that September meeting.
I'm a sensitive guy. What I would note, John, in terms of the data is the compendium of it with the inflation-adjusted yield. I'm going to extrapolate it out here on the break, but John, are you ready for a negative real yield? I'm eyeballing it right now in late October for Halloween as a trick-or-treat, a new negative real yield.
How are you expecting me to take that seriously, that you're a sensitive guy?
I'm a sensitive guy, you know.
Bramo is TK a sensitive guy?
They're forcing me to take tomorrow.
Lisa's not even speaking.
He's
right
very
now.
sensitive to Louis Vuitton.
What did you call it?
What did you call it? I'm trying to think.
Vuitton.
You know, it's
Louis
great.
Vuitton.
Vuitton.
I guess they're doing well. I mean, they're bustling over at 57. I didn't go to 56, but I got to 57th Street.
I tell you who's not doing well.
John, they're forcing me to take
Meta.
off tomorrow. It's un-American.
Facebook's down. Tom's taking a day off.
I'm on Halls.
You're on Halls for how long?
One day.
Long weekend. So American of you. Futures down a third of 1%. Is that it for the summer? That's it for the summer.
Reading.
A long weekend. Tom's summer vacation. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a deal that breaks a long deadlock on major parts of President Joe Biden's economic agenda. Democratic Senator Joe Manchin and Senate Majority Leader Chuck Schumer have agreed on a tax, energy and climate bill. It calls for a 15% corporate minimum tax and would allow Medicare to negotiate drug price cuts. But Manchin blocked expanding the state and local tax deduction known as SALT. Now, Fed Chair Jerome Powell is signaling that more rate hikes are coming. Powell spoke after policymakers raised the benchmark lending rate by 75 basis points. He said the Fed will press on with the steepest tightening in a generation to curb inflation. At the same time, Powell stepped away from the exact guidance he gave at the June meeting. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg has learned the U.S. would swap them for a Russian arms dealer it holds. Griner did plead guilty this month to smuggling cannabis oil in a vape cartridge. According to a Russian media report, Moscow says there is no agreement yet. Billionaire Jack Ma reportedly will relinquish control of Ant Group, according to the Wall Street Journal. That's part of the fintech company's effort to move away from Alibaba, the e-commerce giant that Ma co-founded. Ant was forced to recognize under pressure from the Chinese government. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. And that crack is a sonic boom. Yeah. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
As it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting.
It's such a long road to September. The Chairman Powell of the Federal Reserve, we've got so much data to get through, and I imagine the view on the Fed in September is going to change about 50,000 times over the next 2 months or so. From New York City this morning, good morning, Tom Keene, Lisa Brammertz and Jonathan Ferro. Your market looks like this, negative 1/3% on the S&P, on the NASDAQ 100. Yesterday, up by more than 4%, the biggest one-day pop going back to November 2020. Today, we're down about 0.75%. Yields basically unchanged, TK, 278.12 on a 10-year. The euro showing some weakness, euro dollar negative 0.4%, 101.57.
VIX 23.31 after the festivities of yesterday. Right now on your legislation in Washington, we welcome Jack Fitzpatrick after a sleepless night with Bloomberg at government. Jack, my math is 400 billion off of a $2 trillion list. So I guess 22% of a $2 trillion Build Back Better. Was it that big of a haircut?
Yeah, they shrunk down the list of Democratic priorities really significantly. And even if you look at the revenue raisers compared to what they originally talked about, you know, right. they have a deal now for a 15% corporate minimum rate. They're not changing the corporate tax rate. They're not touching the income tax. Overall, it's much, much smaller. There's no child tax credit extension. They tried that, and it really didn't have the traction that they wanted. So people like Bernie Sanders, who had a big say in the early development of their ideas list, are going to be let down by this. But this is what they realistically can get through the Senate, through the reconciliation process, is what they can get the moderates on board with.
Well, Jack, I want to get ahead past the Sunday programs and maybe past the first Tuesday of November. If I read the, you know, the what's happened in the last 24 hours, is there a left left in the Democratic Party, it sounds like a colossal defeat for the so-called progressives.
I think the defeat was already there. If not for this bill, there was going to be essentially nothing. They were talking about just doing a prescription drug price measure, and that's it. They had already winnowed away at the big priorities. Again, is something like the child tax credit, which was something a lot of progressives pushed for years, and they got through the stimulus. They made it law briefly. It expired, and they just didn't have the political wherewithal to extend that kind of thing. It was clear that, you know, when you heard Bernie Sanders talking about his priority list was about $6 trillion, that was not going to happen. It wasn't going to be anything close to the original proposals. They had their chance, and Biden worked with them to allow them to be the ones putting out the proposals originally, but they couldn't get people like Manchin on board. And so the weight of the Democratic Party has shifted very significantly toward people like Joe Manchin.
Well, there's also been a complete shift in the branding of this, right? It was built back better originally. Now, instead of being Energy Climate Tax Plan, it's called the Inflation Reduction Act of 2022. There has been legislation with this and also the chip semiconductor bill that was passed just recently this week as well. How much does this actually serve as a game changer heading into the midterms?
I think you are right to touch on the branding of this and the fact that they needed to emphasize that look, this bill probably is, there's nothing in there that it really kicks inflation. It has stuff that has a disinflationary effect. It would reduce the deficit a bit. That speaks to the fact that Democrats felt the need to make a point that they were trying to do something. It's not as if this bill or the CHIPS bill in the short term can have an economic effect that would change the way people are feeling in time for the midterms, but they clearly did need to move away from what they were talking about publicly before. And even in the statement announcing the deal, Joe Manchin made a point to say Build Back Better is dead. So they had to do away with the previous branding and refocus on reducing the deficit. That doesn't solve their problems with inflation, but it shows where their priorities have shifted.
Well, the B word is the right word, isn't it? And I'm thinking of branding. For those of you that thought I was thinking about something else, maybe. This from Punchbowl, Jack. This from Punchbowl just moments ago. House Democrats plan to announce a proposal next month to ban lawmakers, their spouses and senior staff from trading stocks, according to people familiar with the matter. Multiple sources close to the issue. Jack, how many different times have you seen that story over the last few months? Is that going anywhere?
That has come up over the last few months. It is a bit more of a major talking point recently. You know, for that kind of bill, you do need, well, to enact it, you'd need 60 votes in the Senate to change the law. Could they do something with the rules in the House to increase transparency? Maybe. You know, it's difficult to predict exactly where it's going, but it has been more and more of a discussion point recently. And obviously with some scrutiny on
Hello traders, how are you doing today? I am, as you can see, we fill the order on Bitcoin. Well done. 23,020. We sold short, sorry, 23,017. We sold short, we opened position on Bitcoin. For newcomers, if you decided to follow trade, you fill the order. It's all about how much you decided to invest. So stay with me. If you want to get a strategy, you need to go to company.co.uk. Otherwise, I'll let you know what's going to happen next. For time being, we're holding this order, and we will see how much profit we will make. Okay? Stay safe, guys.
Minimum timeline on ownership of a given equity. That's all there is to it.
That's one issue. The other is spouses, and Jake Sherman and the team over at Punchbowl acknowledging that at the end of the story, Lisa. Some sources have suggested that the inclusion of spouses is unnecessarily onerous. For example, what happens if a member of Congress's spouse is a stockbroker?
Right.
Does he or she have to quit their job?
Okay, this is all theatrics, right? Because this isn't going to get passed. That's basically what Jack was saying, that this basically is good messaging ahead of the midterm elections. But how much should they be following the same rules that any insider trader, that any big corporate executive would have to follow if they are aware of certain provisions coming down the pike that will move markets and they can still trade off of it? It is logical, and if they're, I don't know, to me it just makes sense if their spouses are hearing what they're talking about. Why not be included? I mean, just
futures down a third of 1%. I'm with you. I'm just smiling at us.
Very clearly,
Tom,
I'm not.
Come on.
Nope.
Tom, if you're privy to decisions that move equities,
put a timeline on the trade. The problem goes away.
I'm not sure if it does. We can talk more about this. From New York City, this is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
One
What is it about Fed Day and the NASDAQ 100? Just a massive day of gains yesterday, the biggest one-day pop going back to November 2020. Then we pull back just a little bit. On the S&P, we're down 1/4%. On the NASDAQ 100, futures down 0.6%. Facebook, a stock to watch, is down in the pre-market. The first ever quarterly sales decline. The stock is down by 5.5%. Later today, we'll hear from Amazon, we'll hear from Apple, and they make up close to, Tom, 20% of the NASDAQ 100. Two big names reporting after the bell.
Yeah, but I'm going to look at the drawdown. John, keep doing the data check here. Oh, I used FB as a symbol. The symbol's not FB, is it?
It's all about Meta now.
Meta,
Tom, I will continue to call it Facebook.
Continue with the data check while I do a Meta drawdown analysis.
You carry on, Tom. We look forward to that. I'm going to talk about the bond market. Put out the ranges for GDP a little bit later at 8:30 Eastern. Positive to close to 2%. The high, the low, negative, close to 2%. And someone messaged me and said you could fit a London bus through that range, and you can. I will say this, though. Some of the more recent forecasts for GDP that come out this morning, the ones that were updated yesterday, they had a big lift to them based on the data yesterday morning, and we'll touch on that in a moment. 297.56 is the yield on a 2-year. This idea that the Fed's moved away from peak hawkishness, we'll get into that as well. We're coming in a couple of basis points again. And the 10-year, this is all about weaker growth in our future. 278.31, Tom, and a way off the highs of the year, which were close to 350.
Do we agree, John, the bond market yesterday was really twisted as Chairman Powell was speaking, and I kept looking at the real yield, which I've mentioned has come in with a vengeance is the right word on it, John, but what did you see across the curve?
The front end just dropping, Tom, and moving away, and it doesn't really believe that we've got much left maybe in our future for this Federal Reserve to do. I'm not sure about that. Tom, I mentioned this at the top of the program. I'll say it again. The Fed's trying to shift away from forward guidance, trying to completely become data-dependent meeting by meeting. And I get all that.
That's what they used to do.
But when they shift towards that, the market's just filling in the space, Tom, and seemingly coming up with the conclusion that this is a dovish move because we're moving away from this committed stance to doing a whole lot more.
We're going to go back to what is Chairman Powell having for lunch. John, to bring up to date here, Meta drawdown, 55%.
Facebook drawdown.
It's a Meta drawdown.
Brutal. Would you call that a meta drawdown?
It's a meta drawdown.
It's a meta drawdown. Okay.
Drawdown. However you want to.
I'm pleased you did the word. That was good. Thank you.
Is that it?
We're so done.
Currency, currency's flat here. Euro, John and I are watching. It just flat out really can't get a bid. Lots going on there, particularly nat gas in Europe. Francis Donald with us now, Global Chief Economist, Strategist, Manulife. Very good at the workings of our GDP. What are we not analyzing in today's GDP first look, Francis? What's the big mystery?
The big mystery is not today's GDP at all. Today's GDP will tell us what we already know, which is that this economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade. And if you told most people that last year, they would not have believed you. The big mystery is what does the next 4 to 6 quarters look like? And this is really what concerns me. It's not recession or no recession this year or even in 2023. It's what do we do if we're stuck in 1% growth for 4 to 6 quarters? That's much harder to trade, much harder for central banks to respond to.
And Francis, what's so important, I featured this earlier, and Justin Fox of Bloomberg Opinion has done great work on it. Powell really skirted yesterday the housing plug-in to GDP, which is if we get yields up, mortgages are slammed, house ownership is slammed, and that means rents sustain and go higher. How does that work into the GDP of the nation?
Well, economists like to say housing leads the market. You nail housing, you're going to get the economy outlook pretty good. In fact, one of my favorite charts is one that shows that housing leads retail sales. So, really focusing on the housing side of the story is going to be critical. It is going to bring down inflation to a certain respect. And it's also very, very bad. Every data point we have on housing is trending downward. Frankly, Tom, every data point we have across the gamut of major primary data points is pointing downwards right now. There's not a lot of places you could look for optimism, unless you do what Powell did yesterday, which is to call initial jobless claims rise not real or to question the validity of the GDP number.
3 weeks of it now, and we might have a 4th week of it later. Francis, tell me why the market's been rallying then over the last month, why credit spreads have been tightening, and what do you make of that easing of financial conditions we've seen?
Oh, bear market rallies, they get bigger the deeper you get into that bear market. I do not believe what we saw yesterday from Chair Powell was a pivot, although it certainly was the path towards a pivot, and markets care about second derivatives. But what Chair Powell told us is, well, he's data dependent. Unfortunately, I don't think that inflation number is going to come down fast enough in the next 2 to 3 months to take out too much of the pricing for 2022. But what this market is going to do, in my opinion, is price in more cuts for 2023. And gosh, that makes the Fed's job harder, just like we saw yesterday. The weaker the outlook, the more we see those financial conditions fall, the more it offsets what the Fed's really trying to do, which is tighten. Look at the break-evens yesterday. They're rallying. That shouldn't be happening when the Fed's tightening 75 basis points. They're probably not happy.
That's actually funny that you mentioned that, because I was just looking at the five-year forward break-evens, and they've been steadily rising the more people believe in this Fed pivot. So what do you expect in terms of pushing back against this? How does the Fed react to a market that's not cooperating and getting ahead of itself?
Well, I wouldn't be surprised if in the next few days, the next few weeks, we do see Fed officials who come out and really try to walk back some of that, speak to some of the hawkish risks that exist in this market. And that's why I think it's dangerous to make too big of a change in your Fed view after a single meeting. And as we've seen this year and a little bit of last year, you can have these big rallies on Fed Day that are then reverse course the very next day. So Fed Chair Powell told us they wanted to be nimble. I think now is the time for economists and strategists to be nimble as well.
Some people who are watching the show, Francis, are probably saying, oh my goodness, here she goes again being bearish. Thomas saying, we're sick of talking about recession, companies adapt. And we are hearing around the margin signs that the rally that we've been seeing is a signal that we've priced in so much bad news that people are beginning to find value. What's your argument against that?
Well, I'm not sure if the she is you or me, but bearish has been effectively the right way to do this. And if you look at the economy, it is still trending downwards. Historically, what we would see is that when the economy is about 2/3 of the way through its downturn, you can start to look for opportunities. And I will be the first to say that macro does not rule all. There will be pockets of advantage here. I think we should watch. I think the curve will still flatten, but we will reach a point in the next few months where you want that steepener back on, and there are always bottom-up trades to be had. So the correlation on macro, it does change over time. It's not the be-all, end-all, but the macro does not look good. When it does, I'll be bullish again.
Francis, what do our listeners and our viewers do is they jump from forward guidance and the comedy that it was to actually just looking at the data? How do you actually get through a week, get through a month, get through a quarter where you are data dependent?
It's a great question, Tom, because we don't know exactly what data the Fed is looking at. And sure, we asked him and he said, well, we're looking at inflation. We want to see compelling evidence. What's compelling evidence? Probably a few months of month-over-month improvements in inflation that is heading downward. They're looking at labor supply and demand, but not all data, apparently, because there's plenty of data that says jobless claims and unemployment is moving in the wrong direction. So we don't know the Fed's reaction function as much today as we did even 48 hours ago. And that's going to make a lot more market volatility, a lot more two-sided conversations. One of my fears is that we're going to have a lot of Fed officials speaking to both sides of the argument. So the clarity on what happens next has been reduced very significantly. And if you're at home and you're thinking, what do I look at? Well, I'm in the same boat.
Francis, I can sense the frustration. So let's address it. What do they need to do better?
I'm not sure it's frustration so much as how much harder are you making the job of knowing what you're going to do next. And the Fed's job isn't to make my job easier. The Fed's job is to contain inflation and really improve the employment outlook. But what would be helpful is if the Fed had more clarity on what elements of inflation they're looking at. Now, 2 meetings ago, we heard from Chair Powell that he was very focused on headline inflation. But yesterday, he said core is the best leading indicator. So I'd love to hear more about what really are you targeting? Because we know that, for example, inflation expectations for consumers are driven much more by gasoline prices than they are by Fed policy. So which elements of this are you really trying to control? And do you fundamentally believe that it's your job only your job to contain inflation? Because inflation came from a lot of places. It's going to take a lot of places to fix.
I'd love it if he could make our job easier. I'll say it. I've been incredibly frustrated by the last few news conferences. Francis Donald there of Manulife Investment Management. Bramo, which data point matters and which one doesn't?
Well, sometimes it's the University of Michigan, sometimes it's the ECI, sometimes it's jobless claims.
Sometimes it's not.
Sometimes it's not. Sometimes it's CPI, sometimes it's core PCE. We will find out as the data drips out, and this will actually cause the data days to be possibly more volatile than the Fed days, because that will be when we have to say it's GDP Thursday. It's ECI Friday.
TK can't wait for ECI Friday. Tom, you've said you wanted to get to a data-dependent stance. That's where they are. The problem we have,
we've been here
and it's still the same problem, Tom. We don't know which data point. We don't have a complete understanding of this Fed's reaction function.
Any legit PhD would tell you it's going to be a compendium, a mosaic of data points that matter. To Lisa's important insight there, or Francis, I should say, on core and a headline, John, I'm going to go to what I've been looking at since the press conference, even in the press conference, is housing, single-family home over to multifamily, the dynamics over to rent. And I'm sorry, it's not a pretty picture.
I don't think it's that complicated. I don't think you need a PhD for this one, Tom. The problem is he keeps flipping from one data point to the other, from meeting to meeting. First it was headline inflation matters, then it was core, then it was about you, Mitch, and to Lisa's point, before that it was about ECI. Tom, I'm not sure what the incoming data actually means for this policy decision in September. I just know that the incoming data is important for the policy meeting in September. I'm just not sure how it's important.
To me, it's
based on what we've heard.
I'm sorry, they're going to look at a mosaic of data and have to come to some tough decisions. And John, what's so critical now is he stated somewhat neutrality is when the going gets tough.
Well, you saw what Dudley said straight after that, the former New York Fed president. Are we neutral, Tom?
Yeah,
Are we?
I'm sorry. I just think that now is where it gets tough.
I agree. Futures down a quarter of 1%.
Lisa, take a note, please. We agree. Yeah.
We don't agree on that Congress story and regulating how you invest/trade.
We'll talk about it later. Villiers just published on the Bombshell.
Okay, well, let's bring that up again in a minute. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a surprise agreement on Capitol Hill. Democratic Senator Joe Manchin struck a deal with Senate Majority Leader Chuck Schumer on a tax, energy and climate bill. It will enact major parts of President Joe Biden's agenda, such as a minimum corporate tax and allowing Medicare to negotiate drug price cuts. It also requires holding oil and gas lease sales in Alaska and the Gulf of Mexico, which could undercut the bill's clean energy focus. Now, a U.S. aircraft carrier and other Navy vessels have entered the disputed South China Sea at a time of rising tensions between Washington and Beijing. The Navy calls it a scheduled operation. China is unhappy that House Speaker Nancy Pelosi might visit Taiwan, which China considers part of its territory. President Joe Biden and China's leader Xi Jinping are expected to speak on the phone today. Etihad Airways has posted a record first-half profit. Long-haul travel revived with the easing of coronavirus curbs, and the Dubai-based airline added flights to European resorts. Still, rising costs are a growing concern.
Simple reality is we're seeing inflation everywhere. It's not really impacting us with the cabin crew and in terms of direct labour in this part of the world. But where we are seeing superinflation is through the aircraft component supply chain. And that's something that's challenging all airlines at the moment.
Meanwhile, fuel costs were up almost 60% from the previous year. Global news 24 hours a day on air and on Bloomberg Quick Take. This is Bloomberg.
on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Demand hasn't fully recovered yet, and supply is definitely tight. There is a lot of talk about limited spare capacity in OPEC+, and we subscribe to that theory as well. The amount of crude oil coming out of Russia has not really diminished an awful lot. That might still come, of course, so I think where we are today, there is more upside than downside when it comes to the oil price.
That's the call from Ben van Beurden there, the Shell CEO from New York City this morning. Good morning, Tom Keene, Lisa Bramett and Jonathan Ferro. Futures negative 1/3% on the S&P. We're down 0.6 on the NASDAQ. Later, Amazon and Apple reporting earnings after the close. Yields unchanged on a 10-year, 278.85 following the Fed decision yesterday. Euro dollar, Tom, negative euro. Euro dollar 101.27. We're negative there 0.7%.
Hugely busy day here, and again, going to the earnings that we'll see this afternoon. Stay with Bloomberg on radio and television all through the day. This big, what is it, John? 19% of market cap?
Just two names on the NASDAQ. Two names make up about 20.
Well, yeah, it's
Amazon and Apple.
Huge deal. This is a lot of fun because she comes with bulletproof academics. Berkeley was known for decades for chemistry, and part of that, of course, is chemical engineering. She's a chemie out of Berkeley. Janine Wade joins us right now with Barclays, their senior U.S. oil and gas exploration and production analyst. Janine, I'm going to cut to the chase. The airlines needed 1, 2, 3 crises before they got capital discipline, before they got the religion of operations. How is oil doing in this boom at capital discipline? Or are they going to go off to the new Siberia and waste it all away?
Oh, good morning. Thanks for having Barclays. I love it. Let's just get right at it. I think you're hitting at the crux of the issue. Capital discipline, whether it's going to hold, is the #1 question from investors. There's a ton of skepticism on that in the market, and that's kept people away. We just checked in with all of our companies ahead of the quarter, and every single conversation, the companies were still on the right narrative, which was low growth and max free cash flow.
Okay, well, let's go right to the chase, Janine, just because of time. Chevron has always been the wild card. They're the Arco of the modern world. Explain Chevron's capital discipline. Who is keeping them in line?
Investors are keeping Chevron in line, just like how they're keeping every other company in line. Energy was the worst performing sector for a number of years, and then that's because they were destroying value, no returns, nothing was getting returned to shareholders that was anything meaningful, and the shareholders are spoken. And what Chevron did was they reduced their capex budget by $5 billion a year for the next 5 years, which is huge. And they've embarked on a big buyback program. You know, the buyback right now is $5 to $10 billion, and we think that they're going to raise the low end of that. We're already at $10 billion for the year, and we think our investors are also at $10 billion. So the market has really instilled capital discipline on the whole sector.
Janine, earlier this morning, Shell posted a record profit for the second straight quarter, and they also accelerated buybacks. Tomorrow we get the likes of Exxon and other oil majors that are reporting in the U.S. What's the political risk as they start to report these blockbuster bonanza earnings on the heels of oil prices that have become a campaign speaking point?
Right. We have midterm elections coming up in November. It's a huge focus. Oil companies are definitely in the crosshairs because of all the profits that they're making. But let's just face it, you know, the companies are making a lot of money because oil prices are up, but they didn't make a lot of money for a lot of the other years. So what they've been doing with the cash is they've been enhancing the balance sheet and they're giving the money back. So, you know, we already saw that companies are delivering on this show me the money mentality that investors have right now. We think that Exxon could potentially talk about their $30 billion buyback program. They just tripled it last quarter, so it's unlikely that they increase it this quarter, but we think that maybe there could be some shifting or front-end loading of that. We just talked about Chevron, how we think they're going to raise the bottom end of their buyback guidance, and so that'll bode very well. But, you know, companies have a couple of options. They can either reinvest in growth with all that cash, and that's pretty much a no-no right now. They can pay it out via dividends and buybacks, which we think they're doing, or they can hoard the cash.
But that's exactly the point. It's a no-no right now to invest in more production at a time when a lot of politicians are saying that's exactly what's required of these companies. What is the risk? How do you price out the chance of perhaps some sort of excess tax put on these companies if they don't invest in production, or some other policy kind of check to try to, if nothing else, be a talking point heading into the midterms?
That's a good point. We think the political risk in the headlines is very high, again, because we have midterm elections. But in terms of anything actually getting through, we think the risk is low. So we've seen a windfall tax in the UK. We think that's highly unlikely in the US right now. Oil companies, they need a more consistent, friendly fiscal regime and a constant regulatory environment in order for them to really commit to plans and to increase growth. And when they don't have certainty in what taxes are going to be, if permits are going to go through, if fracking is going to be allowed, that's when they're not able to plan. And then you won't see as much production growth.
And policy continuity, it's a massive problem, has been for a while now. Janine, thank you. Janine Wade there of Barclays. This from the White House, some guidance from them. 2:15 Eastern time, Tom. We'll hear from the president delivering remarks on the economy. Tom, GDP's out a little bit later. Now, I have to say, if the administration didn't make as much noise as they had about this whole idea that it is a recession, it's not a recession, I wouldn't really be paying attention at 8:30. I'd expect just a positive print and move on. It kind of spooks you a little bit, Tom. Makes you wonder what we're going to get at 8:30 Eastern.
And even more importantly, folks, you have to realize there's a second and third look as well, and the real adults only wait for the third look. I mean, when everything's adjusted out. But come on, it's a political football into an election season, so I'm not surprised that he's going to trot out whatever the message is, including trumpeting this bill. John, I got to say, Greg Valliere was not scathing, but he made clear this is a bombshell piece of legislation. The president's, I'm sure, going to take a massive victory lap on it. And Valliere says, by no means does this look to be passable, mentioning even the funding to the IRS.
Yeah.
I mean, it's fascinating. It's very sophisticated.
It's a big win, a big change in the last 24 hours or so.
Yeah.
Elisa, I imagine, will address that GDP print too. It's become so political in the last week.
Well, partly because it reflects the pain that people are feeling, so then if they can put a narrative on it with numbers behind it, that starts to get a little bit stickier in terms of a narrative, and it becomes more difficult to dispel heading into the midterms. Perhaps it's easier to say, look at oil prices, look at energy prices, gas prices are coming down because of the SPR release. That's a simpler story to tell than a bifurcated, where is the inflation pressures, is employment picking up, et cetera, which is nuanced and doesn't play well in politics.
Tying yourself in knots, trying to explain the GDP story. Tom, gas prices are down every single day since the middle of June. Continues to be the trend. I see so many tweets. The media don't talk about it. The media that we do every single day. We're doing it again. Gas prices are down every single day since June.
Yeah, I'm looking at, it's away from the ugliness, but where people are going like, where were we before whatever their framework is, 2-3 years ago, and we're up off those lows. Program note, John, and this is distressing. I didn't know Harry Kane is the only one on the planet who can hold at 29 years old.
Hold what, Tom?
It's his birthday today.
Oh, right, okay.
And he's like holding.
How do you know this stuff?
29, forever.
What does the holding bit mean?
He's not going to ever turn 30.
Oh, right.
That's the way it works.
He's like permanently 29.
Permanently 20, like you.
Is that what his agent is telling you?
Yeah.
So that he gets a better contract?
I hope so.
Is this the agreement that you were promising me for the rest of the show?
Birthday. Happy birthday, Harry.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you're a Fed who cares about inflation
or cares about unemployment, the right thing to do is to address inflation head on.
For now, they're very much still steering towards higher interest rates and higher inflation. So I don't think they're going to pause.
The economy's been stronger than I think that people realize.
We do think that the market is over expecting a Fed pivot in the near term. I can't see how that happens.
I don't think the pivot will occur as soon as some people are hoping for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is GDP Thursday, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative 0.25% on the S&P. TK, the data, 90 minutes away.
Yeah, we're going to pivot to the data here, 90 minutes away, and pivot and go into it, go beneath the headline data. Michael McKee giving us great assistance on that. John, you know, I'm going to look at the data. I got to admit, I'm going to look at the export-import dynamic. I thought Bruce Kasman was brilliant on that the other day. John, can I just say, before we get carried away with pivot, right now the Red Sox are pivoting, okay? What does pivot mean? I mean, it's like with President Obama when we were pivoting to the Pacific Rim. It's just, what is pivot?
How did that work out? Tom, it's this idea that you go from 75 basis point hikes down to 50, down to 25, maybe you pause, and then eventually have to go the other way. It's a change. We've gone to a data-focused Federal Reserve. Tom? Forward guidance is gone. You know all these things. And the market has found the little gap and decided that that is a dovish tilt from this Federal Reserve. Tom, do you think the easing of financial conditions are desirable or undesirable
this is really
for this Federal Reserve? And I think that's got to be the big question after the move we've seen.
And Alarian was brilliant on this yesterday in parsing out the financial system versus the real economy. What can they really do to manipulate the real economy? Do they have control of the real economy? And the answer is not.
He kept saying things like there's more tightness, more tightening coming through the pipeline based on what we've already done. Lisa, it just gave off on the impression that he was ready to wait and see, look around and see what happens.
Really? I mean, I'm not sure. We're not sure what he is actually intending. I don't think he knows what he's intending. I'm talking about Fed Chair Jay Powell in terms of where the economy is going, because they are aware of both risks. And I think that's what people are keying into, at least according to a lot of analyst notes. The fact that the Fed is saying we understand that if we go too fast, too far, we could cripple the economy, even as the economy is weakening, at the same time that they have to fight inflation. The fact that they even gave a nod to that other risk was enough to make people bullish on equities.
The City are taking the other view. They say this, and Andrew Hollenhorst put this out in the hour after the decision. We read Chair Powell's press conference as more hawkish than the market's interpretation. They continue to expect core inflation to push the Fed to hike more aggressively than they or markets anticipate, with a 75 basis point hike in September, policy rates reaching 4% by year end. The market's interpretation, as we clear the risk event yesterday, is very different to what's going to happen in the next couple of months, potentially, Tom. We're going to be highly data dependent, very, very sensitive to it, and there's a lot of data still to come before we get to September. And I imagine, Tom, we're going to whipsaw from one interpretation to the next based on the incoming information.
And I'm going to go back to where we are, which is neutrality is described within a fairly wide band. And once we get to the neutrality, you move on to the first restrictive step. Again, not really knowing where it is it September, or, John, do we really focus on November to keep employed?
For you or for Chairman Powell?
For me. How about, seriously, John, Janet Yellen off of the bill last night, how long is her employment at Treasury? The global tax thing went down in flames.
The minimum tax.
Yeah,
Senator Manchin maybe breathing some life back into this administration, at least for now. We'll hear from Secretary Yellen later. Lisa, we'll hear from the president too later this afternoon.
He's going to be speaking at 2:15, talking about the economy. How is he going to message it? Is he going to talk about the strength? Is he going to be talking about the need for the Fed to be aggressive? How is he going to head into a midterm elections where a Fed is saying that a rising unemployment rate is by design? A very difficult political message.
Who wants to say that out loud? Not the Fed right now. Futures down 0.25% on the S&P. On the Nasdaq 100, we're down 0.6%. Yields unchanged on a 10-year, 278.85. Crude inching back to $199 and about 12 cents. Euro dollar 101.34. Just getting some confirmation from the White House, Lisa. They have confirmed the time for Biden and Xi to have talks, 8:30 Eastern time.
Yeah, and we've been wondering when this would happen. 8:30 a.m. seems to be the time. We're also going to be hearing from President Biden at 2:15 p.m. We'll get get to that in a second. At 8:30 a.m., we also get second quarter GDP numbers. It is GDP Thursday. How much is that going to shape anything? I actually don't find it as interesting as initial jobless claims, because right now, how much does the labor market dictate whether the Fed starts to reconsider how quickly to raise rates heading into the year? Because that seemed to be one of the reasons why Powell seemed to think that there was still strength in the market. So going to that 8:30 call that President Biden is going to be having with Xi Jinping, we have confirmed that it's at 8:30. How much is he going to talk about lifting some of those tariffs from the Trump era? At 1:30 p.m., we're going to hear from Janet Yellen, Treasury Secretary, speaking about the economy. 2:15, we'll hear Biden reignite some sort of debate about what a recession is and how strong the economy is. That'll be really interesting to hear. Then, of course, after the bell, we get a slew of earnings. 56 companies are reporting in the S&P, accounting for about 19% of the total market cap of that index. And John, as you were pointing out, Apple and Amazon account for about 20% of the NASDAQ index. Both of them really to give interesting reads on the consumer, especially interested in Apple, considering the recent price cuts in China, considering the slowdown that we have seen in demand for semiconductors as well as personal computer devices.
Bramo, thank you. Looking forward to those earnings a little bit later after the close, if we can stay awake. Chris Harvey, Head of Equity Strategy at Wells Fargo, joins us right now. Chris, it's good to catch up. What did you make of the dovish interpretation of this market after that Fed meeting yesterday? Is that something you endorse or something you want to fade?
No, it's something I endorse. One of the things we've been talking about is we're seeing cyclical inflation peak, right? Prices are coming down, whether you look at the commodity prices are coming down. Break-evens across the board are coming down. My 401k is coming down, so a negative wealth effect. And overall, what we're seeing is what you would expect. Financial conditions tightening, the economy slowing down. And we don't talk about pivot. What we say is when the Fed toggles things down, and the Fed has toggled things down, that's when the equity markets can start, holding gains. And I think they will hold gains as we go forward.
Chris, for Factor success over the next 12 months, how important is sector analysis? To me, it's as critical now as it's been in, say, 20 years.
Yeah, Tom, we spend a lot of time on factors because what we see is typically across all the capital markets, a factor really influences price, sector, stock. Last year was duration. Duration expressed itself across the fixed income markets, the equity markets, U.S., international markets. And what we've seen over the last couple of weeks is we've seen more of a risk on as people, I think, since CPI really interpreted the Fed to become a little less hawkish, right? There was demand destruction. Prices did come down. And again, I'll harp on break-evens. Break-evens across the board have come down and come down significantly.
So, Chris, what's the risk that the opposite is happening now and will actually prompt the Fed to be more aggressive? I was looking at break-even rates, and if you want to take a look at those, and people will disagree on how noisy they are, they've been rising in the past few days on the heels of this belief in a Fed pivot. Basically, the more people believe that the Fed is going to back away from their rate hikes, the more they see longer-term inflation rising well above that 2% goal. At what point does the Fed smack down this market and basically say, you guys are operating away from our goals?
There we go.
Yeah, I don't know if smacking down the market is part of the Fed's dual mandate. As far as break-evens, yeah, there is some noise. One of the things that we thought is break-evens were going to be in a 250 to 275% range. They're now in a 225 to 250% range. So it's much lower than we would have thought. A lot of people were saying, well, that's 10 years, but look at fives and twos. Right across the board, across maturities, 5-year break-evens, everything has come down. And that's what we expect. We are seeing demand destruction. We are seeing commodities come down. We are seeing the economy slow down. And so you would expect commodities to come off you would expect inflation to come off the boil. Yes, there is some geopolitical risk, and that's going to keep it elevated for some period of time. But that cyclical inflation is coming down, and that makes a ton of sense to us.
I don't think the bear got much sleep last night,
No,
TK.
no,
at all.
I don't think so.
Chris Harvey
Chris,
of Wells
thank you.
Fargo. Bared up, Bramo.
No, I'm not bared
Do you know
up.
who's on the same page as you?
Yes, Bill Dudley.
Neil Dutta
Yes,
too.
actually, I saw
of Renaissance
that.
Macro. Let
Neil,
me read the quote for everyone.
I just want to let you know, Neil, I read this last night. My heart went out to you.
The fact that the Fed hiked 75 basis points and financial conditions have eased is a problem. Renaissance Macro go on to say, looser financial conditions make the Fed's objectives more difficult to achieve, Lisa. Pricing in cuts after you have hiked undoes the efficacy of hikes in the first place.
This was what Bill Dudley said. He even put a number to it, that a 5 to 10% stock market rally would cause the Fed to see that that was moving against what they were trying to do, and that would cause them to really give guidance, even though they're not giving guidance, that they don't want to see that. How much does this become just a churn, right? And I think that that's what people are looking at, and that's what Frances Donald, maybe she doesn't call it frustration, maybe exasperation, with the complete lack of guidance that everyone's feeling. How do we see that expressed in the price action?
From two different worlds, this is really important, folks. We do economics, finance, investment, international relations. In Pharaoh demands we do politics as well. John, what you just saw there was the Yardeni-Harvey pivot.
Sure.
Coming from two different parts of this industry, and the giant economist Ed Yardeni and the incredibly competent Chris Harvey both said the same thing. There's a point where you pivot to risk on, and maybe that's in the continuum of this summer, what we've seen.
They're not alone, and that's been the market interpretation, I would argue, not just of the last 24 hours, but of the last month.
And you're never on board then. You never see it. That's why I'm in triple leveraged all cash. I never see the entry point.
Yeah. Tom, the difference between a bear market rally and a recovery, you find out pretty late, don't you?
Yeah, the cliche, John, in America is the boat left the dock. And the answer is, I've never gotten on the boat, to be honest, but where's the boat? Where's the dock?
I've got
what
no
are we
idea
doing?
where we're going now.
You heard Yardeni.
You've totally lost me.
No, you heard Yardeni there, and I'm sorry. Ed Yardeni said, climb on board. June was the bottom.
8:30 Eastern time, we get GDP, and if you're just tuning in, we'll also have a call between President Biden and President Xi at the same time. So that's 8:30. Then a little bit later, the president's going to talk about the economy. What time is that, Lisa?
He's going to talk about it at 2:15.
2:15. There we go. Bramo, with the promo for the Fed this month, was taking a sledgehammer to inflation, and now it's all about, what was it, slamming down markets, slamming them down. Futures down 0.25%.
It's Thursday.
I know. I didn't sleep either. From New York.
It's Harry Kane.
This is Bloomberg.
It's Harry Kane Thursday.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a surprise agreement on Capitol Hill. Democratic Senator Joe Manchin struck a deal with Senate Majority Leader Chuck Schumer on a tax, energy and climate bill. It will enact major parts of President Biden's agenda, such as a corporate minimum tax and allowing Medicare to negotiate drug price cuts. It also requires holding oil and gas lease sales in Alaska and the Gulf of Mexico, which could undercut the bill's clean energy focus. Now, Fed Chair Jerome Powell is signaling that more rate hikes are coming. Powell spoke after policymakers raised the benchmark lending rate by 75 basis points. He said the Fed will press on with the steepest tightening in a generation to curb inflation. At the same time, Powell stepped away from the Pacific guidance he gave at the June meeting. Strong words today from North Korea's Kim Jong-un. He marked the 69th anniversary of the deal that ended fighting in the Korean War by threatening to, quote, eliminate South Korea. Kim also said he was ready for any battle with the U.S. North Korea is believed to be preparing for its first nuclear test since 2017. JetBlue has agreed to buy discount carrier Sprint Airlines, the price at least $3.8 billion in cash. The deal comes less than a day after Sprint ended a pending merger with Frontier because of a lack of shareholder support. The deal is likely to face a stringent review by antitrust enforcers in the Biden administration. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand